Welcome to I Got a Guy podcast, a podcast carefully designed to introduce a wide range of very talented and highly skilled professionals ready to share their knowledge and advice with you. Please welcome the host of I Got a Guy podcast, Michael Drelichars. Welcome to I Got a Guy podcast. I'm your host, Michael Drelichars. Thank you so much for being here. To all of our loyal subscribers, we thank you so much for your weekly listens and downloads. We know you're getting great information from our guests because we have really awesome guests every week. And every now and then we have a repeat guests like we do this week. So I'm anxious to get started with this episode. If you've missed any of our past episodes, you can go to igotaguypodcast.com. That's igotaguypodcast.com for more information about all of our past episodes. See a short synopsis about each one of our guests and decide which ones you want to listen to. Hopefully you listen to them all. And we also encourage you to share this with your friends, your neighbors, your relatives, where you see the fit, where you see a need, you see that somebody has some questions that they need answered. We probably have the answers for you. So certainly go to igotaguypodcast.com. And this episode is also going out on YouTube, so you can see the episode on YouTube at precisefleettracking.com. So look up Precise Fleet Tracking in the YouTube channel or I Got a Guy podcast in YouTube, and you'll find this episode. So encourage you to do that, and we'll keep growing and serving more people. I Got a Guy podcast was born out of my constant need for networking. In my small business, I network a lot, and as do a lot of small businesses. Networking is an important component. I read a book called The Go-Giver several years ago, and it actually inspired me to start this podcast. It's all about giving back. And I want to help my referral partners and my clients grow their businesses, and in turn, it grows my business. We kind of share alike and help each other with our business growth. In that book, The Go-Giver, they outline 5 laws of stratospheric success, 5 things that really help businesses grow exponentially. And one of the laws is referred to as the law of value. It's defined as give more in value than you receive in payment. And I really think that embodies our guest this week. He really shares a lot of really valuable information all the time with his customers and his prospects, helping them be better and be in line for growth. So we're going to talk in a lot of detail about that today. So please allow me to welcome our guest this week. Our guest is Jordan Abdel-Haq from Homeside Mortgage. Jordan, thank you so much for being with us today. We appreciate you joining us again.
Mike, thanks for having me. Glad to be here.
Always. So Jordan is a mortgage broker, and he really takes this business very, very seriously. And as I mentioned, our law of value, give more in value than you receive in payment. He does spend a lot of time educating his prospects and his clients about how to be best positioned to secure a mortgage and what things you need to do. And I think that's always true. You always need to have your credit in a proper line, and you need to have your details queued up properly. But it's even more critical now that the rates are so much higher than they used to be. So I'm anxious to get into a conversation with Jordan about that. But Jordan, why don't you tell us a little bit about Homeside, just for our listeners that may have missed our first episode, which is quite some time back. Tell us a little bit about Homeside Mortgage and how you approach the mortgage business.
Yeah, so Homeside Financial is a DBA of Lower LLC, which is our corporate brand, fairly large size correspondent lender, probably top 60 to 75 in the country. So a good sized operation allows us to have, big company type resources, technology, benefits for our employees. But more so our local brand here in the Chicagoland area is known as Team Hochberg. And there's about 10 of us on the team that service loans all over the Chicagoland area, and more so than that, in the Midwest and really beyond now. The traditional loan officer probably would write a bunch of loans in Illinois, but now with the landscape the way it is, a lot of people are leaving the state. So it makes a lot of sense for us to be licensed in other states, whether it's Indiana, Wisconsin, Michigan, Tennessee, Colorado, Texas, Florida, Georgia. You name it, our team can cover several states throughout the country. Team Hochberg is our local brand that most people here in the Chicagoland area recognizes for, but Homeside Financial is the corporate. It's a great company led by some great individuals and very collaborative company.
Great. So yeah, Team Hochberg, that's this local brand. Well, that's great. And so you've been in the mortgage business for quite a while. Got quite a bit of experience.
It's been about 3.5 years. My previous work life, I worked in the golf industry for about a decade or more than a decade, really, and had a good opportunity to move to this team. Obviously, timing was great with the refinance boom, so had the luxury to see tons and tons and tons of different type of loan setups, scenarios, whether it be someone's got a bankruptcy or foreclosure or damaged credit, you got to help repair, or just the more cookie cutter transactions, which we always welcome as well. The whole spectrum. I've seen about 800 loans in about 3.5 years, which most loan officers are fortunate enough to probably see in their career, or at least probably the first decade. So I consider myself fortunate in that way that I've been able to see a lot of different types of transactions in a relatively short amount of time.
Sure. Well, and you've kind of, if you think back 3.5 years, the real estate market was booming, and the rates were low, and you've kind of ridden the wave up and down on that. Now it's a whole different market.
Yeah, most definitely. I mean, I joke, I say we got in at one of the greatest times and also, one of the worst times because it was such a great market that you didn't really understand what a normal market looked like. And now we go from that to one of the toughest markets that we've seen in a long, long time. So we've really not seen, me personally, a normal balanced market.
Sure.
So we've seen each end of the spectrum here, and it's been a learning curve, but we're looking forward to it. There's a lot of people that probably got in when I did, and they're like, "This is easy. We're printing money here. Loans are so easy. You're just like shooting fish in a barrel." And now a lot of them are getting out of the business because it's tough. It's tough to provide for your family. It's tough to put food on the table. And read a lot that loan officers will probably shrink by about 40% by year end or into early next year, which, we view it's tough. I mean, I feel for those people, but we view that as an opportunity if we can make it to the other side of this storm, if you want to call it that there'll be a lot of market share to pick up because so many people have gotten out.
I couldn't agree more. I think this, if you're able to weather the storm, and it's a nasty storm, there's no doubt about it. But if you're able to weather the storm, you will be so much better at when you come out of it, and be well positioned for what will hopefully be a normal market. It'd be awesome if sometime in 24 things will stabilize and the rates will come down a little bit, and it may not be at the 2.5 or 3% rate, but if it's at 4.5 or 5%, that's pretty darn good.
Yeah, certainly. There's a lot of things that'll come with that. I mean, there's so many homeowners across America that have got a 2.5, 3 to 3.5% mortgage rate, and even if they want to move or kind of need to move, if they don't absolutely have to because of job relocation or families growing and they run out of space, they're staying put because they can't stomach the difference between 2.5 and 7.5. But as rates come back down into the fives and potentially fours, I think a lot more people are going to be able to stomach that pain. I don't know that that's going to correct the inventory shortage that we have entirely. I don't think it will. I think it's also going to bring a lot of buyers, especially younger buyers that are sitting on the sidelines right now waiting for those rates to drop, which, we're going to have a lot of buyers for still probably not enough homes for sale. And we think those values are going to continue to increase. I think the August numbers were home price values were considerably higher than what they would have expected. And that trend's just kind of continued, and we think will continue going into next year as well.
Yeah, I've spoken with some home builders, and there's still a shortage of inventory, and based on the simple fact that it takes time to build these homes and these housing communities, and frankly, there's a shortage of laborers, that I think the shortage is going to last for a few more years. I think it's going to take us a few years to catch up with the supply and demand curve.
Yeah, I think there was probably a decade or so where they probably wish they would have built more homes than they did. And now you have this massive millennial generation that's, reaching their peak home buying years. They've got growing families. They're making more money. Um, so there's a huge pent up demand. And yeah, you're right. It takes some time to get that supply to level up, and it's not going to happen overnight. I think builders are getting smart. I've been reading a lot about them targeting more homes that are more affordable for first time home buyers. As you and I well know, you look in the northwestern suburbs of Chicago, typically the new construction you see is priced, starting at 450 to 500,000. Now you're starting to see some more affordable type housings because these builders are getting smart with the rate environment and understanding that we've got to build some more affordable homes. So I think that's a good thing as well.
Yeah, it is good, because you're right, and not everybody can afford a $500,000 home. It's just not practical. These the millennials, just getting into the market. They're making good money, but a lot of them have college debt, and a lot of them, don't necessarily have the down payment saved up because they haven't been, working long enough to squirrel away that much money for the down payment. So they have to start somewhere, and so we definitely need to have some lower cost housing, um, to allow people to get started.
Yeah, I think you bring up a good point there too, Mike, with the student debt. It's very top of mind right now because there's $1.7 trillion of student debt across America that's going to come due again starting in October. Those payments were deferred for the longest time because of COVID and the like. And that's gonna affect a lot of people. So the average payment's going to probably be $300-400 across America. So that's going to be billions and billions of dollars that's not spent elsewhere in the economy because now those payments are going to be required. So it all goes into this, and hopefully that'll have an impact on inflation and bring that down, and the mortgage rates will tend to follow that. But we'll see how it plays out.
Yeah, it will be interesting to see exactly how it unfolds. But you know, hopefully these folks that have the student debt also have well-paying jobs, and they are living within their means and able to pay their commitments, make their commitments, uh, to the student loan, to their for other assets, their cars, etc., and still able to squirrel away some money to have a down payment. I know you happen to. I've seen some of your reels on Instagram, and I guess it'll be Instagram. Um, I don't do Snapchat, but I know you do some little short tutorials and little advice um, snippets, and a lot of it has to do with helping your credit, improve your credit scores, and keeping your debt to income ratio, et cetera, in line. Share some of those thoughts with us, some of the things that you've talked to folks about.
Yeah. So from a credit aspect, we like to take a look early on because it's not the only thing that impacts your interest rate and the affordability for that mortgage, but it's a key factor. And we have some tools in which if we have a credit report, a live credit report in front of us, we can run what if scenarios to see, hey, maybe we pay this credit card balance down to this, not necessarily pay it off, but get the utilization rate down, maybe say under 30% is kind of the optimal. We can play with those tools. Maybe there's a collection, a medical collection that very common during COVID. They were, a lot of hospitals were understaffed. Bills were going to the wrong places. People were unaware of this bill, and all of a sudden it gets turned into a collection, and somebody's got that reporting on their credit report for a couple $100. The government's tried to make some improvements on that and those types of things, not necessarily negatively impacting someone's
Sure.
score, but in some cases it has. And you talk to the customer about it, and they're like, "I have no idea. Why would I have not paid a $300-400 collection off? Look at the rest of my credit report. I've got nothing delinquent, nothing out there, small balances." And you're like, "Yeah, you didn't know it existed." So we can talk them through ways to remedy that. And I've seen 80-90 point swings on people's scores by addressing things like collections that they weren't aware they had. Also, huge improvements by just getting some of that credit card balance down. Again, some people have the ability to do it, some don't. Another interesting stat is, American credit card debt is over $1 trillion right now, with an average interest rate of like almost 23%. It's astronomical.
Yeah.
So another
Staggering.
way we're helping, yeah, it's crazy. So another way we're helping people is to restructure some of that debt, whether it's a cash out refinance in the primary mortgage. May or may not make sense depending on the rate. We did a gentleman's loan earlier this year. I think he went from 4.25 to maybe the low sixes or high fives. I can't remember exactly what it was. So yeah, his rate on his mortgage got considerably higher, but he was also consolidating a ton of credit card debt, and his monthly out the door expense was like $1,400 less, even with the higher mortgage rate. Our goal with him was when rates come back down, we'll lower that rate and just do a simple refinance at that time to get his mortgage rate back where it was, or close to it, hopefully. But if the cash out refinance doesn't make sense, and a lot of times it doesn't, a home equity line of credit makes more sense. We don't do those personally. I get nothing out of it other than if it's the right thing to do for the customer. That's what we like to recommend. So we have outlets and referral sources that will point that client to. So it's a wide array of things. It's just, most importantly, it's about doing what's best for the customer. It all comes back, whether we get anything out of it. You do the right thing, and it all comes around. I see so many loan estimates from different lenders throughout the country, from my clients that want me to take a look at it, and you would be astounded at what they're trying to sell some of these people to consolidate their debt that feel like they have no other place to go, charging thousands and thousands and thousands of dollars in fees. I saw one the other day. It was like they were considering paying $15,000 to pay off $35,000 of debt. Like, who would do that? But these guys and gals that are selling these programs are very creative, and they don't necessarily break down the numbers as well as you would hope. And some of these
Sure.
clients just think that that's the only option for them. And in some cases, maybe it is, but more times than not, it's not. There's a better option out there that, again, we don't make any money off of, but it's best for that client.
Sure. Well, and you have to ask the right questions, and you have to have the right advisors on your side of the table to help you through that. So that's where your experience comes into play, and your demeanor, and it sounds like the culture of your mortgage company, whether not only Team Hochberg but Homeside Mortgage. Sounds like you guys have a culture of serving your client as in the best possible way, irrelevant of what fees you're going to generate. And like I said, in some cases you don't even generate a fee or a commission or income, but you're providing this value because it will come back to you full circle.
Yeah, absolutely. We spend so much time on education and doing the right thing, not just Team Hochberg, but like you said, our entire division as a whole, a bunch of like-minded guys and gals that are just consistently trying to do the right thing, not only for our clients, but for our referral partners as well. The realtors and financial advisors, things like that send us referral business. Even if it does not turn into a transaction for you, if you do the right thing by that client, that referral partner takes notice, and he or she is like, well, that was really impressive. I know he didn't get anything out of that, but now you build a deeper relationship with that partner, and it becomes just that, not a transactional relationship, but a really deep rooted relationship that provides value to one another, just kind of like you alluded to in the opening.
Yeah, most definitely. And it's and when you have the right referral partners, the right in whether it be a realtor, home inspector, insurance agent, mortgage broker, these you all work together very closely, and you one transaction may you provide advice and you get nothing for it, but because of providing that value, you will be lined up for many more opportunities that do fit your main part of your business, and you will grow your business that way.
Absolutely.
And then certainly as an individual, you'll be able to sleep comfortably at night knowing that you did the right thing, and it's not always about what the income that you generate, but adding value, like we said before, give more in value than you receive in payment, and it all comes around full circle.
Yeah, no, absolutely. And I tell people that more times than I'd care to admit, quite frankly, where I'm telling them, listen, this is not the right thing for you. Uh, and honestly, probably something I could sell if I wanted to, but you're exactly right. I wouldn't be able to sleep at night knowing I put that person in a situation that wasn't most optimal for them. So absolutely, it's about doing the right thing. And you'd be surprised. A lot of clients that I not turn away, but I steer elsewhere to a product or something that's better for their situation. It might be a month goes by, and all of a sudden I get a random call from a number I don't recognize. I answer it, and they're like, "Hey, so and so referred me to you." Well, I never transacted with that person. I just did the right thing, and now they're serving as a referral partner to me as well. So it does come around.
Yeah, no doubt. So, do you work primarily with first-time home buyers, or do you do a lot of folks that are like what we consider move-up buyers, people that are potentially at some point going to want a bigger house or another house, et cetera?
So we cover the whole gamut, quite frankly. We do work with a ton of first-time home buyers, and that's really fulfilling because it is so much about education. They have no idea what they're getting into. Very, very stressful. They'll in some cases talk to a few different people, and you ask them about the process and what they learn. Talking to the other lender or whoever it may be, and they don't come away with a lot. So at the end of every conversation with the first time homebuyer, and yes, we do spend a lot more time with them. Um, we make sure they're fully comfortable. They don't have any outstanding questions. Their spouse that may not have asked anything, but was present on the call, we want to make sure they're comfortable as well. But certainly, especially like my close knit network of friends and the like, or a lot of them are moving up from maybe their first condo or townhome to the single family home. So we do a lot of step up type of deals as well. But I've also worked with a ton of people that are retiring and downsizing. So, and we can not only just help them with if they need the mortgage, in some cases they don't need the mortgage on the townhome or whatever they're trying to downsize to, but they'll call me because maybe we've worked with them in the past or they know me, and they'll say, hey, do you have a realtor you can recommend to sell my current home? So that's a way we just constantly try to stay in touch with everybody in our database multiple times a year, whether they're at 275 and I know that call is not going to lead to a transaction. You'd be surprised at how many times just by you picking up the phone, calling on your database, whether it's 100 or 1,000 people, what that can turn into. This year alone, I've had 3 listings that I've been able to refer out to realtors just in the last several months in the northwest suburbs, which is great. Again, I'm not getting anything out of that list side, but I'm providing value, direct value for that to my realtor partners. And, if the client turns around and needs to buy something with financing, great if I get it on the backside. But just picking up the phone can do a lot for you personally. Maybe they got a daughter, son that wants to buy, but also it can do a lot for your referral partners as well.
Yeah, that's awesome. That's very important. Jordan, we're going to take a short break here and then come back and continue chatting. But before we do so, why don't you share your contact information with our audience so they can reach out to you directly? What's the best way to reach you?
The best way, I've got a landline number. It gets redirected to my cell phone number, but the best way, and again, it's a Champaign-Urbana area code. I'm in the Chicagoland suburbs. A lot of people get confused by that, but it's a 217 area code. My direct cell phone number is 217-649-3105. Again, 217-649-3105. And my email address is Jordan, Jordan, and then the letter A for my last name, at homeside.com.
Very good. Okay, I will put that in the show notes so everyone will see that and be able to reach out to you directly. And to our listeners, if you do reach out to Jordan, and I hope you do, tell him that you heard about him here on I Got a Guy podcast. It's a great way for us networkers to know where our referrals are coming from, and we connect the dots that way. And it's just a great way to keep things going and know who we need to thank for the referral that we receive. So, but we'll take a short break and we'll be right back. We'll continue chatting with Jordan about some of his successes, and I got a few more questions for him. So stay tuned and we'll be right back. We certainly hope you're enjoying this week's episode, and we'll return to this week's guest in just a moment. But now a message from our sponsor, Precise Fleet Tracking Solutions. If you own a fleet of vehicles, even if it's just 2 or 3 vehicles, GPS tracking is an important component for every vehicle. Here are the 5 top reasons companies invest in GPS tracking: driver safety, vehicle location, driver behavior, proof of service, and monitoring vehicle maintenance. Precise Fleet Tracking Solutions can enhance your growth and profit through the use of GPS tracking technology. Reach out to Precise Fleet Tracking Solutions at www.precisefleettracking.com. That's precisefleettracking.com. Or call 847-865-6008. That's 847-865-6008. Precise Fleet Tracking Solutions. GPS tracking made simple. Now, let's get back to the show. Okay, we are back. Thank you for sticking with us. I am Michael Drelchars, host here of I Got a Guy podcast. Our guest today is Jordan Abdel-Haq from Team Hochberg, a Homeside Mortgage company, and he's a local mortgage broker here in the Chicagoland area, but licensed in, you said, several states earlier, right?
12 states in total, yeah. But our company is licensed in nearly every state nationwide, so we can help you out wherever it may be.
Okay, get a resource wherever you are. Okay, good. So, Jordan, thank you for joining us again, and we appreciate the information you're sharing and helping our listeners, understand this aggressive market that we're in. The rates are so high, and if you're looking to buy a home, there aren't a lot of homes to purchase, so a lot of challenges there for the first-time home buyer. And I know you put a lot of effort in helping those buyers be prepared when things do line up correctly.
Yeah, absolutely. And I guess let me make it clear that buying is not for everyone. And in a lot of cases, renting may make more sense or does make more sense for that particular person. And that's okay. We never want to pressure anyone into buying if they're not ready. But if you can stomach the payment, if you can comfortably afford the payment, still be able to save a little bit and pay the rest of your bills, then we think it's a great way to build wealth. One of the best ways to build wealth, especially for a young person that gets in early. But absolutely, it's not for everyone.
So you just mentioned something that I wanted to chat about for a second. Years ago, the mortgage industry recommended that a home buyer spends no more than 30% of their gross income on housing, and their total debt to income ratio is like 36%. I think that's changed recently. What are the current standards so people kind of get an idea of what can they comfortably afford?
Mike, I don't know that it's changed that much. Certainly some people stretch it more than others. And we just like to have that honest conversation. We're not going to talk them out of a purchase because without knowing their whole scope of history, maybe they've got a big inheritance they're coming into or something like that. But generally speaking, 30 to 35% debt to income ratio is still a very comfortable place that we'd like to see most clients. Now, where we see it get outside of that and considerably higher. So there are a lot of instances where several different scenarios where this might make sense. But just put it this way, if you have a husband and wife, wife's got much better credit than husband. They both work, but their interest rate's going to be significantly better with just putting the wife on the loan, and her income is enough to carry the mortgage to qualify for the mortgage. Maybe their back end debt to income ratio is 49. So it looks really high. You're like, if I was talking to a first time single home buyer, I'm like, I would have that honest conversation of your debt to income ratio is really high. I want to make sure you're comfortable with this and not going to have to make lifestyle decisions or changes that you don't want to make, cut things out that you don't want to cut out. But when you have a secondary income there that is not qualifying on paper, but in reality, that debt to income ratio is much lower. We see a lot of that.
Gotcha.
But I think generally speaking, I don't think that standard's changed a whole lot. Certainly we'll do several 42, 43, 45, 47 debt to income ratios. But I think that the kind of the gold standard is if you're around that 30 to 35% range, that tells us that you're going to very comfortably be able to afford the monthly payment and likely be able to save on top of that.
Right. Yeah, and that's actually the most important part. You because I mean you never know what curveballs life is going to throw anybody, and if you start out stretching yourself where you don't have much of a cushion to grow your savings, um, you're really setting yourself up for a stressful life, and you and my biggest concern is if somebody were to get over their skis and not be able to save money early in their, let's say, in their mid 20s, um, that could be a situation where you never get out of that cycle, and then you're
And I
always
think that's happened, right? I mean, I think that's probably in large in part to why we have Americans in over $1 trillion of credit card debt. So it's like,
right.
all of a sudden you can't afford the mortgage payment, or maybe you can, but you got to throw the rest of the expenses on the credit card. Um, I think that's an issue. I mean, there's
Yeah.
certainly times where it's necessary. Maybe you lose your job, or you're going to bounce back, and that's just what you got to do for the time being. But yeah, I think you're spot on. You always want to have a plan to attempt to save, and things happen. You never know, and that plan may need to change for the short term. But getting into a mortgage payment that right off the bat, you're going to be stretched. Um, that's a little frightening.
Right. Right. And I think the other aspect is with the real estate market being as short in such short supply right now. It's easy to sell your house right now. Plenty of people buying it, but where you want to go to, where are you going to go to move to next? Really makes it challenging, because if you're in a situation where you're over your skis and you need to sell your house, well, now you need to essentially downgrade. Um, you just don't have enough choices. I think you paint yourself into a corner, and it's a little risky.
No, absolutely. And even the people that, we talk to a lot of people. "Well, we're gonna sell. We're gonna capitalize on the top of this market." And I'm like, "Well, great. So what are you gonna do once you sell?" "Well, we're gonna turn around and buy again, or we're gonna rent." So you're gonna sell in a high market. You're gonna turn around and buy in a high market. So where have you gotten there? Or you're gonna sell in a high market. You're gonna turn around and rent, and it's an inflated rent market as well. So I'm just, you don't talk those people out of that necessarily, because if that's the decision that they want to make, then that's for them to say. But a lot of people that say, "Hey, we're going to sell high, and we've got family that we get along with well enough to bunk up with for the next foreseeable future until this thing cools off," maybe that makes sense. But I don't know how many people are in that situation, especially young families that want to maybe move in with the in-laws or what have you. But
Right.
yeah,
Well,
I hear that notion so often. We're going to sell high, but then what?
yeah, and I've heard. Gee, it's probably been a year and a half. Individuals are predicting that the market's going to cool off because it can't stay this hot. It's going to level off, and the reality is it hasn't. And I don't know that it will, because there's just too short a supply. So
Yeah,
I think believing it's going to be a short term 3 or 6 month kind of adjustment for the market to come down, I think is not rooted in fact. There's a lot of supposition, and people look back at historically when the real estate markets have ebbed and flowed. Um, I don't think we're really anticipating a major market correction where all of a sudden rates are going to, or home prices are going to drop by 30%.
yeah. I mean, you hear a lot in the media about crash, crash, crash. There's a lot different lending standards than there were, back in '07, '08 time frame.
Sure.
There really weren't a whole lot to speak of. A lot's changed since then, and that
For the
was that
good.
was
For the
really
good.
the biggest for the good, yeah, for the better, right? It makes our job a little bit harder, or in some cases a lot harder, but for absolutely for the better, because we can't get loans through on no income, no docs. Everything's fully well documented and scrutinized to make sure that that person or persons can comfortably afford that payment. So yeah, you've only seen the values increase. Maybe they level off a touch, but I don't see that happening. I don't think you're going to see the level of delinquencies that you saw back then, because again, these mortgages are so heavily scrutinized to get done in the first place. So I think values are going to keep increasing. We do believe the rates are going to come down. Again, probably never going to see the 2s and 3s again. But if we level into the 4s and 5s, then all of a sudden, even if values keep increasing at a normal appreciation rate of 4 to 5%, if rates drop 2 to 3%, that's going to help affordability in a big way.
Certainly. So let's assume that 10 or so months from now, the rates start to come down. Let's look at mid-year or next summer, 2024, rates come down, and who knows if that's reality or not. But what do you tell a prospective first-time home buyer to do today so that 10 months from now they're in the best possible position to buy their first home, townhome, condo, what have you? How do you coach them?
Well, I think there's a couple different sectors of first-time homebuyers you're talking to. The ones that can comfortably afford to buy now, even at 7.5% to 8%, I'm telling if you can stomach it, buy it now and refinance it later. To the folks that can't stomach that payment now, we're just trying to position them as best we can from a credit perspective and from a savings perspective for the down payment, right? Keep your credit cards at this utilization. Don't go out applying for every great credit card offer that's out there, because the number of inquiries doesn't impact your score. So while maybe you kept your credit cards all at 0, you applied for 15 this year, that's going to have an impact. So we talk all of that through, and maybe look at their budget. Again, it's not my space. I'm pretty good at it. I've kept a budget since I was in high school. But maybe just, some people their brains don't work that way. And you don't want to overstep. You got to do it in a polite way. You got to ask if they want some guidance or want you to take a look at things. But I've had people send me everything. Hey, can you put this into an Excel spreadsheet or a Google Doc? And, we'll take the time to do that if it allows for them to put away a couple $100 a month or whatever it may be to better position them when they are ready to purchase that home.
Yeah. And the recommendation is still to put 20% down on a purchase, so you avoid the private mortgage insurance, right? That saves a lot of money for the buyer.
Not necessarily. I mean, if you can, and that's not going to deplete your entire savings, then great. I have a lot of clients that do put 20% down, but I would say the majority are putting somewhere less, 5, 10, 15% down. Had some first-time home buyers do as little as 3% down. And again, the cost of the private mortgage insurance on a monthly basis heavily dictated on your credit score. So somebody's got a 780 credit score, and to get to 20% down is going to wipe out all of their savings, all of their nest egg account. And they're a first-time home buyer that doesn't have the furnishings to put in the new house that's much larger than the condo that they were renting downtown, what have you. We talk through that and say, hey, listen, you can do this. I'm not talking you out of it, but you're buying a home that's 60 years old, furnace might go out, AC unit might go out, hot water heater might go out. You may just want new furniture. You never know what's going to happen. You may want to put in a patio, what have you. You may lose your job. We don't like to speak in fear, but it's a reality that could happen. So a lot of people, the cost of the PMI, again, is heavily dictated on the credit score and the size of the loan. So I've had $300,000-$400,000 loans where someone with a solid credit score is paying $30-$40 a month at most in PMI, which is not that much. But if that's the difference maker between them depleting their entire life savings, I think it's worth considering.
Sure. Oh, that makes sense. I thought it'd be a lot higher. The private mortgage insurance, more than $30 or $40 a month.
As you get down into the lower credit scores, it'll get a little more costly.
Sure.
Certainly.
All based on risk, right?
Right.
So when you do have a mortgage that has private mortgage insurance, does it automatically go away when you've accumulated more than 20% equity, or do you have to refinance to get out of the PMI?
No, it'll say right on the loan estimate that you get up front when the PMI falls off. But yeah, generally speaking, it's most people think 80%. Most banks, when it gets to 78%, is when they'll automatically drop it off. At 80%, you could request it to be removed. In some cases, they may require an appraisal. You can also ask for it to be removed earlier, which is happening a ton right now because of how much homes have appreciated over the last
Right.
couple of years. So, and that's another. So we call on past clients for a number of reasons. A, just to see how they're doing. It's the right thing to do. Wish them a happy birthday. Maybe they had a baby that you saw on Facebook. Congratulate them. B, just to see how, if they've ever want to do an annual mortgage review, to review their other debts, make sure they're best utilizing their mortgage. Make sure they're not interested in selling their home. And if so, we can set them up with a realtor to give them, a market analysis on what their home may be worth. Maybe asking them if they've ever considered, if they're not already, working with the financial planner. And if they need a recommendation, we can make that recommendation. But for a number of reasons, we reach out to past clients, but also a lot of the talking points right now are revolved around a couple different things. Home equity lines of credit, because they're so popular. Again, I said we don't do them, but we want to make sure our clients know that we can refer those out because 8-9% on a HELOC is much better than 22% on a credit card.
Sure.
Recasting, I won't go into right now, but a big one is early removal of PMI. So because these homes have appreciated so much, we'll look at their situation and say, hey, maybe this person is paying more, $120 in PMI, but we were like, you definitely reached the 20%, the 80% threshold on your value versus your loan amount. Call up the person that's servicing your loan. In some cases, it's our company. In most cases, it's gotten sold off by that point, right, to Chase or Wells Fargo. Call them up and see if you can get early removal of PMI. And even if they want you to pay a couple $100 a month, or a couple $100, for the appraisal to get rid of that PMI, if you're paying $100 a month, that's a no-brainer, right? You've recovered that cost in 3 months, and you've gotten out of the PMI, in some cases years and years before you should have, especially right now with how much the home prices have grown in the last couple of years.
So that could be a matter of even 6 months.
A customer like $19,000 the other day because they were paying $200 a month in PMI and they got out of it X number of years early. So it's a huge deal.
Yeah, but that could be even after like 6 months in the mortgage, right? I mean, the way the home values are escalating, right?
You're right. Yeah, 2020, 2021, 2022, yeah, and even still now, they're still on the rise. So absolutely. I mean, you could get rid of it much, much faster than what you had originally thought.
Yeah, that's great. So, you touched on credit score briefly. Help us out for those that may not be real familiar with the details. The best credit score is 850, right?
I've never seen one, but yeah, in theory, that's there. Yeah.
So what the normal good credit is like 780 to 800? Is that
so? It used to be. So there's three credit bureaus. We use the middle one for qualification. If there's two spouses or two partners in the loan, we'll use the lower middle to qualify. So TransUnion, Equifax, and Experian. It used to be before last year or earlier this year when Fannie Mae, Freddie Mac put in these loan level price adjustments. It used to be the gold standard was 740. If your middle was 740, it didn't matter if you were 740, 780, 810. The rate was going to be the same. Well, now they've got these tiered pricing adjustments. So now kind of the gold standard is 780 and above.
780.
But anything above 740 is still very, very, very good. But 780 is the new gold standard that used to be 740.
Okay. So do you recommend your clients subscribe to a service, and there's a few of them out there, but Credit Karma is one that I know I'm aware of, so they can monitor their credit score and see how things would impact it on an ongoing basis?
I don't know that. My only issue with Credit Karma is that we see so often that, and this is more for the mid-level credit scores where Credit Karma will tell them they're 712 and we'll pull it and they're 675 because that's more of a surface level glance. It's not a deep dive into your entire credit past that a mortgage inquiry is. Even if you look at like I know my Chase and Amex cards, they offer free FICO checks, once a month or whatever it is. Even if I look at that, it's going to tell me my credit score is 840. Well, I know if I pull my credit score as a mortgage inquiry, it's not going to be that high. It's like when you buy a car, you get a credit card. They're not doing the deep dive in the past. That is the case if you're doing a mortgage inquiry. So I think it's a good idea to use some of those free checks every now and again, just to make sure nothing jumps out as glaring, like all of a sudden your scores drop 60 points. Maybe you got some kind of fraud that you need to look into. But I also, on the other hand, would not put, so much stock into that being your exact score. I think it's a good thing to use as a barometer.
Okay. Yeah. Keep you in the ballpark and at least aware of how things can impact your credit score.
Sure.
You go to that department store and they're offering your free credit card, you unless you really need it, you really want to be careful.
Yeah. If you're doing an inquiry or two a year, it's probably not going to have a huge impact. But the people that are having their credit run several times a year, that's where you see some hurt. I think the non-traditional credit reporting type stuff, I actually did a video on this, I don't know, the last couple of days. For first-time homebuyers, there's things you can do. Let's just say you don't have a credit history established because you were fortunate enough to where your parents were able to pay your bills in college. You don't have any student debt that you're paying back on. They were able to pay your cell phone bill, your utilities, and those things don't typically report to your credit, but you can have them report if you need to establish some credit history. So even I think my story the other day was I had a 40-year-old first-time home buyer that paid for cash everything in his life. Never had a credit card. So he's like, oh, my credit score should be great. And I pulled it and they were not great. And I said, that's because you have no history. There's nothing on here. He's like, what do you mean? So we set him up with the credit builder loan, or you can do it via secured credit card, where essentially you're giving $1,000 deposit to a bank. They're lending it back to you. You're making monthly payments. Seems kind of bizarre in theory that you're giving them your money to lend it back to you. But that bank is reporting those timely payments to the credit bureaus, which will help establish that credit score for you and that credit history. Other ways to do it, Experian has a boost program that will report, if you ask them to report timely rent payments, ComEd bills, cell phone bills that don't normally get reported to the bureaus. They'll do that as well. So different things out there that you can get that established. But we mostly see that. This guy was a little bit of an anomaly. It was great that he's paying for everything in cash his whole life, but mostly we see that with young folks out of college. They get a good job, they want to buy, they're ready to buy, but they've got no credit history established.
Yeah, it's interesting because I've been aware of that, and when my oldest daughter, was a senior in college, she rented a house. Her and four other girls rented a house. She was the first one to move into the house. She had a summer internship, and so she had to call all the utilities to get the utilities started, and she put them in her name and her social security number. And my advice to her was, this is great as long as you pay your bills on time, because utility companies really do report that information. It's a really solid platform. So she collected rent from all of her, not the rent, but the utility payments she collected from her roommates, and she paid the bill every month. And she ended up with a very good credit score because she made those payments on time for a year. And so now, she's just got her full-time job, and now she's at some point gonna start her life on her own, and she's got a solid foundation. So I'm happy that she followed my advice and paid her bills on time, and she does have a credit card as well that she uses a little bit and just pays off every month in full, just to show the payment history.
Absolutely.
And they want to see the pattern that you're
Right.
responsible.
Yeah, just pay your gas, your groceries that you were otherwise going to put in your debit card, put it in your credit card, and just pay it down. We say every week, if you can. It's not going to hurt you if you're only paying it down when it's due, but the more the credit companies are reporting to the bureaus and your utilization can be as low as possible, the greater chance you have of those scores being higher. But it's certainly not going to hurt you if you're paying the bill on time every month. But
right.
We think it's a decent strategy just to set up a weekly reoccurring payment, just to make sure anytime Chase reports your credit card to the bureaus, it's always below that 30% threshold.
Sure. And by doing that, you also don't pay interest on that. So, the interest can get very expensive, as you've talked about, 23% interest. So if you carry a balance, not only does it hurt your credit score, but it costs you a lot of money.
Oh
That
yeah, if you ever want to get freaked out, look at. Unfortunately, I'm able to pay my credit card balances in full each month. But if you look at the bottom of the statement, say if you just make that minimum payment, nobody reads this. But if you look at all the way at the bottom, if you were to just keep making the minimum monthly payment, it tells you how much lifetime interest you'd pay, and it's an astounding number.
Yeah, it's staggering. And it's a situation where that's assuming you use the credit, you don't charge any additional transactions to the credit card. That's
Right.
just that current balance as it knows of that day. So it really can get out of control in a hurry. But yeah, so I try to advise my daughters to be prudent, but I think it is important to establish a credit history, payment history, and be responsible. And I mean that's part of being an adult, right? So
Absolutely.
but that will set them up for a little easier time when they do go to apply for their first mortgage, when they have a good credit history and a good score, and hopefully a good amount of savings built up where they can make a nice down payment and together get a little lower rate, no matter what the rate is at the time.
And not have to have you co-sign.
Yes, exactly. Yeah, but that's an important component as well. But well, that's great advice, Jordan. I really appreciate you providing that information. I'm hoping our listeners will share this with maybe they're already established, but maybe they can share this podcast with their college kids to get their foothold started very solidly and get on the right course early and not have to fix it, but get started in the right way.
Yeah, no, and like I said, Mike, we love working with first time home buyers. It's very rewarding. Getting someone in their first home, how excited they are, all the stress they may have, the feedback we get after, whether it's a Google review that they leave on our page or whether they just a text message and they say, it was all worth it. We're so happy. Thanks so much.
Yeah.
But I think there are more people than you would believe coming out of college that are getting good jobs, high, decently paying jobs that can't afford to get in right away. And one thing I'll leave if we're wrapping up here, a lot of people think you need a 2-year work history to get a mortgage, and in some cases that's partially true. But we can actually qualify you based on your time in college. So I've got a police officer down in Central Illinois that's been on the job for 1 year, but he was in the police academy and he was in a criminal justice program in college. Obviously, he was naturally trying to be a police officer. So we were able to use his time in school as his work history. And he's going to buy a house when he finds one well before the 2-year mark is up.
That's really good. That's good information. I was not aware of that. I had also heard the same thing, that you needed 2 years now part of the 2 years of experience is to be able to save up enough money for a down payment.
Sure.
So you have
Sure.
to have,
Yeah,
but
but in some cases, people didn't ever spend a dollar of graduation money or whatever they may have gotten over the years, or maybe they were fortunate to have an aunt or uncle that gave them a little money every birthday or Christmas. They've got a little bit of savings that they never had to use, and they have enough to do 3 to 5% down payment, and
sure.
they can still stomach that payment. So it definitely happens, and just so many people are not aware of it. And if you told them, they're like, well, I'd rather been paying this money towards a mortgage as opposed to a rental payment. Particularly where we see it very, very valuable is if, like your daughter, she was going to buy a 2 to 4 unit property and she can afford to do that. She's going to get money from her friends that are going to live there in the other units as rental income, or maybe even in her unit, they're going to rent out the other units. Maybe they go in and buy the building together and they live together in one unit, rent out the other three that's paying their mortgage and maybe even cash flowing at that point with a very small down payment. They hold that property for 12 months. And maybe at that point they're engaged and want to move. They can now go buy their primary residence and they've got this great wealth builder of an investment property right off the bat.
Yeah, that is a great way to go to get started, because there are plenty of people that are willing to rent. and or need to rent. And the rental market is still strong. I have income property myself, and it is still a strong market. So it's and have a multi-unit building, a 3-flat or 4-flat, where you can theoretically pay the mortgage with 3 units rented. If that's
Absolutely.
possible based on the numbers, then you live for free or almost free. It's a beautiful thing.
If I had to do it over again coming out of college, that's what I would have done when I was ready to do it. But you don't know what you don't know. But I think that's a great thing for young people to consider.
Yeah, that's great. Well, great advice, Jordan. And we are going to wrap up here. But why don't you share your contact information again with our listeners if they want to have a one-to-one conversation with you and explore their situation?
So direct cell phone number again, call or text is 217-649-3105. And email address is Jordan A, so JORDANA @homeside.com.
Very good. I will put that information in the show notes, and our listeners can see that and reach out to you directly. And to our listeners, please let Jordan know that you heard about him here on I Got a Guy podcast, and he will let me know of the success of all of the calls he's been receiving. So I look forward to that. So Jordan, thank you for being part of the show this week. We really appreciate that, and best of luck to you as this market ebbs and flows and continues to provide opportunities for you.
Yeah, I appreciate that, Mike. Thanks for having me. And one more thing I would like to mention. I think this is so important for any service or product that you're looking to buy is reviews. Maybe you can drop this in your the show notes as well to my Google review page. You can just Google my first and last name. I have a complicated last name, but that'll be the first hit, and you can read some of the reviews that my past customers, whether I knew them or not going into it, have had to say. I think that's very valuable in today's day and age. So if you're a small business owner and not collecting reviews on Google, I think you should start, right away.
Yeah, definitely. That is great advice. So Google reviews at Jordan Abdel-Haq.
That's
Is that
correct.
how it's listed there?
Full first and last name, you Google it, and it'll come up on the right-hand side of the screen there. And I'm not saying give me a review, but I think it's so important if you're working with someone you don't trust on, especially such a large, or you don't know, I should say, on such a large transaction, that you read some of those reviews before you even make that initial phone call.
That is great advice, and I will put that in the show notes so people can get a link right to it. Well, thank you very much. And again, this is Michael Drelichars, host of I Got a Guy podcast. But my day job is Precise Fleet Tracking Solutions. We work with small and medium-sized businesses that own commercial vehicles. And we help these business owners enhance their growth and profit through the use of GPS tracking technology. So if you happen to own a business or work for a business that has commercial vehicles, it could be construction business, could be landscaping, could be towing, could be delivery company. If there's a logo on the outside of the vehicle, there should be a tracking unit inside the vehicle for a lot of reasons. And we'd love to have a detailed conversations to help you understand why that is and how we can help. So please reach out to Precise Fleet Tracking Solutions at 847-865-6008. That is 847-865-6008, and we'll have a full discussion and see if it makes sense for you. So again, thank you so much for listening to I Got a Guy podcast this week. Thank you to Jordan for his insight on the mortgage industry, and we look forward to speaking with all of you again next week. So until then, make it a great week. Take care. Thank you for listening to I Got a Guy podcast. For past podcasts and more information, go to igotaguypodcast.com. That's igotaguypodcast.com. Please share this podcast on your social media feeds and tune in again next week to I Got a Guy podcast.